So I think we've mentioned some of the reforms and the guidelines we've introduced. The other dimension is really to, one, do public education, but also to encourage a deepening of the markets. So some of the things we've done involve market development. For instance, we supported the introduction of the commodities exchange, which gives those who are interested in agriculture to participate, because there are financial investors who may want to play on agricultural products. Not necessarily to own stocks, but to actually own maize, to own actual agricultural goods. So that's one avenue that we've created. We also did a bond market diagnostic study. Now, if you look at some of the issues, this guaranteed return issue, a question comes up that if you want a fixed return, if you want a guaranteed return, how do you get it in this market? How accessible, one, is the treasury bill market, is the corporate bond market, even the government bonds. Government also issues long-term bonds. So making that accessible so that you on your phone, from the comfort of your home, can sign up to corporate issuances, which you do your own analysis and you can subscribe. But when the fund manager also buys a bond, he can build a portfolio for you and tell you that this is the portfolio that I have built for you, so that you know what goes into your fund. It's not that you put your money into a black box and you don't know what's happening. All you know is 10% or 15%. So that's important. We also introduced what we call private funds guidelines, which is a new product. What we saw was that some of the fund managers were investing in equity of SMEs. Now, when you invest in an SME, the skills and the structure and the governance requirements are quite different. You need to understand the operations. You need to have the capacity to go on site and look at what they are doing. And you have to understand the financials and their cash flows. Now, do your workers have that capacity? So we've introduced this product that requires that those who want to manage private funds come through the commission to get a license. We'll do an assessment so that when people are going and a person says, oh, I am investing in SME, you have to ask them, are you duly licensed to do that? Do you have the requisite capacity? And then what is inside the portfolio that you've built for me? We also introduced what we call real estate investment trust guidelines. So again, in our economy, housing and real estate plays a big part. And some of the fund managers actually put their monies into real estate. Real estate is a good asset class if you have the financial capacity to go in there. If you have the long-term funds, because you have to commit. And the day you need liquidity, the value may not be the same if it's an emergency versus if it is a comfortable withdrawal. So introducing these guidelines provides a range of products that the financial sector can then invest in a more structured format, greater accountability, and greater transparency.
Okay.
So that makes the fund management business, I would say, a bit easier on the market operator side, because then they have some frameworks. I'm either doing listed equities, I'm either doing REITs, I'm either doing a private fund, I'm either doing pensions, or I'm doing something else. So that's something else we can now interrogate on a much more specific and deeper basis, right? So that you, the investor whose money is there, you can ask the fund manager, where have you taken my money to? How have you invested it? And how did you make that investment decision? I mentioned the digitization efforts as well. We started that in 2019, actually. But 2020, we started a beta version. We are pursuing that as well. And it's very important because what we are doing as part of our regulatory regime is to migrate from a compliance-based supervision framework to what we call a risk-based supervisory framework. So you look at the risks in the industry, you still look at the compliance requirements. They start to meet all those compliance requirements. But now you apply what we call risk weights to the various dimensions of it. And that helps to allocate our resources more efficiently. Okay. It helps us to delve into the problem areas. Otherwise, it's like spreading yourself too thin. Where are the problem areas? Where are the risk buckets we see? So that we can be more efficient as a regulator. Clearly, you mentioned that we had some challenges as well. And we acknowledge that. Financially, we were under-resourced. Our structure, where we operate from as well, is actually a temporary building. So we cannot even hire as many people as we would want, even though we need to hire people. If your office space is limited, that becomes a challenge. So we're actually working very hard to get a new structure, and the mechanisms are in place. We went through a process.
You still don't have that?
We still don't have that, Winston, unfortunately. But we're working on that. And that's also a very important intervention that we expect to have.
Let me just do this.
Sorry, the last thing was that part of the challenge is also the vision for the market. What kind of market do we want to have? So along with that, we launched the Capital Market Master Plan, which is the first master plan. There were other financial sector development plans that were broader, covered insurance, covered pensions, covered banking, and capital markets was in there as a smaller component. With the Capital Market Master Plan, it covers the entire capital market. It's focused on the areas that we have oversight on, but it also spells out some responsibilities that some of our stakeholders have to contribute to the development of the market.